Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and due diligence. Plus, every Sunday, I put out our weekly MicroCap wrap to show how the microcap space has performed every week and compared to the broader market based on data from the MicroCap Review Index. So again, to subscribe, please go to microcapnewsletter.substack.com. For this episode of the Planet MicroCap Podcast, I invited on frequent guests and friends of the show, Jason Hirschman from Hudson 215 Capital, Yaron Naymark from One Main Capital, and Josh Young from Bison Interests. If you've been following MicroCap performance for 2022, it's been nothing short of a bloodbath. Data from the MicroCap Review Index shows that the space is down approximately 27% since the new year. Awesome. I wanted to make sense of this with three of the best minds in the game today. Thank you again for tuning in to episode 234 of the Planet MicroCap Podcast. And please enjoy my conversation with Jason, Yaron, and Josh. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today are three folks that I have immense respect for, and I'm so excited that they're here to kind of talk a little bit about what this first half of 2022 has been like for microcaps and otherwise. And I don't know if we're going to turn it into a therapy session. We'll kind of see where it goes. But with that, I'm really excited to be joining me today. We got Josh Young from Bison Interests. We have Jason Hirschman from Hudson 215 Capital, or Hudson 215. I always do 215. I don't know. I'm in LA, so it's 818. The whole thing.
No problem, Bobby.
All right, and then we also got Yaron Naymark from One Main Capital. What's up, Yaron?
Yeah.
And thanks, guys. It's good to have you here.
Great to be here.
So as I said in this quick little intro here, we're going to be kind of wrapping on the first half of 2022. Let's start specifically in microcaps, and then I'm sure it'll quickly diverge into beyond that. But at least to start, it's been a rough go. We published from our newsletter, the MicroCap newsletter, which you can subscribe to, microcapnewsletter.substack.com for free. Some recent data on new constituents, how the index has performed, and it's been a bloodbath. Let's just call it like it is. So, I mean, I figured let's I'd like to hear how everyone's experience has been in that regard. So, Yaron, how's it going, man? How's it been for you in this first half, and what have you been seeing? What are some reasons why? You're usually pretty good at giving like the kind of big picture look at what's going on. So
yeah, look, I think we came into the year with stocks reasonably valued. I don't think they're cheap. I don't think they were expensive. I think the prospects for economic growth were relatively good. There were some rumblings of inflation starting to tick up, but I think everyone was of the view, or I was, and I think a lot of others were of the view that inflation was still hopefully on the cusp of transitory, meaning supply chains, which had been jammed up coming out of COVID, would hopefully kind of, get some WD-40 in them and stop squeaking. And, people who got a lot of stimulus funds would go back to work, and so the supply picture would get better, and the demand would be relatively stable to good over the course of the year. I think that environment very quickly morphed, closer to the end of Q1, but throughout the year, where I think it's become very clear that inflation is not as transitory as people thought it was. Doesn't mean it's not going to roll eventually, but Russia invaded Ukraine. That didn't help, obviously, with fertilizer and food and energy prices. Demand for energy globally, as the world reopened, has kind of returned to its growth trajectory that it was on pre-COVID, while supply on the energy front is not fully recovered. And then, the people haven't come back to work to the same degree as everyone thought they would. So inflation has ticked up, and that's caused the Fed to have to tighten financial conditions pretty dramatically here in the first half of the year. And the tightening of financial conditions is bad for all risk assets. At the same time, the outlook for inflation is also bad for earnings, right? When you have the Fed tightening, that's generally bad for demand. That's how they're trying to tame inflation. But supply also is still constrained, and so if you have tightening of demand conditions, while at the same time all your costs are going up, that's a stagflationary environment, and it's really not good for earnings. So higher rates not good for multiples, stagflationary environment not good for earnings. And I think in general, market participants have just shifted to a risk-off mood, and it's definitely understandable why people don't feel that confident to invest in risk assets right now. But I will just highlight that we've gone from my view being fairly reasonably valued to pretty cheap in a lot of pockets of the market, and it's rare that you're able to buy things for cheap when there isn't a lot to worry about. So yes, there's a lot to worry about. It's rare that it's pretty much never that you're able to buy, lots of things for cheap when there's nothing to worry about. That's when things are cheap. And I think if you have an investment horizon of more than 2 months or 6 months or 8 months, I think this is when you need to be buying assets. I'm not saying you need to be all in or levering up here. But I don't think that, people who are calling for going to all cash, you might get one of those calls right once over the course of your life, but you might not, and you might forego a lot of gains if you try to kind of get in and out every time you think, things are going to be tough. You're not going to always get it right. And I think over time, it's proven that if you buy things on the cheap and you have a time horizon to wait it out, you're going to do well. That's kind of my summary.
Yaron, really appreciate that full summary. Let me cut to you, Jason, real quick. And, what has been some of your reaction, maybe bouncing off of some of what Yaron just said?
I mean, Yaron did a fantastic job. I think looking at a lot of the factors that are affecting microcap investing and really all investing right now. Just a few things to add on. I mean, first of all, as microcap investors, we should be used to misery from time to time. It just comes with the territory, right? If you can't take that kind of punch once in a while, then this isn't the place for you, right? I think Bobby's his face is turning so red, it's almost like he can feel it. He's a microcap investor at heart, right? He can just think of the punch and he already just starts feeling it. But I
feel it for everybody.
You feel it for everybody. You feel it for everybody, right? On the other hand, it's not that tough because misery loves company, right? And a lot of investors are down right now. So in some ways, we compare ourselves to each other. And if everybody's down 20, 25, 30%, it's not, except for Josh, who is investing in oil and gas, is probably up 62,000% or something like that. But the rest of us mere humans don't have that benefit right now. I would say part of the problem is, though, being a microcap investor right now is that if you look at large mega cap names, you look at the Amazons, you look at the Googles, right? They're down too, right? So you start asking yourself, like, or other investors may ask themselves, am I getting sufficiently compensated for the extra risk of playing down in this microcap land, right? And so all assets are starting to re-rate as interest rates go up and things get a little more challenging. And it's interesting times. I mean, it's a terrible time if you have to sell today. But if you have any kind of cash, or if you want to just upgrade your portfolio by just getting rid of some of your weaker names, it's a great time, right? So that's the way you got to look at it. I think you got to be a little bit more optimistic and say this is the time to trade in your Hyundai and upgrade to a BMW, right? You're not really paying that much of a premium. So that's the way I look at it.
Absolutely. All right, so I want to get Josh's take, and then we'll dig into some a little more of what you and Yaron also said. So, Josh, from your perspective, how has it been for you in this first half of 2022?
Well, the very end of the first half was quite painful and undid a lot of the gains from being exposed to oil and gas. I just looked on a 1 month basis as of right now, XOP, the mid-cap index for the mid-cap ETF is down about 25%. So just over the last trailing 30 days. So it's been a month, and that last little bit, there's been just incredible volatility and craziness, and a lot of Yaron walked through some of the setup that I've spent years trying to convince people of, and now it's sort of more of like a known narrative of there being sort of insufficient supply over time while demand has sort of continued to increase. And so it's an interesting world to be in, where this sort of long-term thesis is somewhat understood, at least among sort of more sophisticated and knowledgeable investors. But at the same time, there's kind of this disbelief in terms of it being a real factor that would play out similarly to how it's played out historically, where historically, when there have been many years of underinvestment for oil and gas, there's been many years of recovery. And there's this just sort of presumption of, oh, hey, there were like 7 bad years and 6 good months, and so that's it. And it's like, well, that's just not, you end a cycle through oversupply. You don't end the cycle through prices being high for a minute or a month or 6 months. And so there was this great Peter Lynch quote as a follow-up to what Yaron said, where far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. And so it's very hard, I think, to sort of keep your head when there's craziness going on. And I guess, unfortunately, I have a lot of experience with this, where basically oil and gas stocks went one direction for 6 years, which was down. So, we named the firm after a bison, we sort of face into the storm. And I think it's just really hard to stay cool and collected and proceed analytically. But like Jason was saying, I think downturns are great opportunities to be able to find opportunities, high grade portfolios, deploy risk capital. And it's not really anyone that says they can time a bottom or whatever. I mean, no one can. Even I read this thing, 2 more thoughts. One, I read this thing about Jim Simons, the founder of Renaissance. And apparently in 2007, when all the quant firms were blowing up, there was this sort of quant-mageddon. He came in and overrode his computer signals, and a whole bunch of his scientists got mad at him. And he said, look, it's my firm and we're selling. They thought they should buy, and they sold, and they survived and did very well. And so I think there's a certain pragmatism and a certain ability to sort of, see through whatever it is that the narratives are, and be able to sort of take a longer term, more measured view. And then for oil and gas, specifically for small caps and micro caps, it's the divergence in between small and micro cap performance and mid and large cap is wild. And it's like actually one of the interesting things. I mean, apparently this has been going on across the board, and it was just things were terrible for oil and gas in general. So it didn't matter if you were big or small for a number of years. But in this recovery, the PSCE small cap index is still down like 80% from its high from 2014, while XOP is down, now I'm not sure, but like as of a month ago, it was down, let's say 50% or so, and XLE was down like 30%. So there's a huge divergence in trailing return for the small caps in oil and gas. So here you had supposedly this big, powerful bull thesis. You had supposedly all this money coming in and sort of chasing it. And then you had a valuation divergence, the biggest maybe ever for the sector, but specifically on the big versus small, where the big guys were at, let's say, 4 or 5 or 6 times EBITDA, and the smaller companies were at closer to 2 times EBITDA. So very interesting, big divergence, relevant for the small and micro cap crowd. And, you know, really like when you see a sector working or not working, either way, you can sometimes see these sort of divergences that tell you a whole area is interesting. And one of my takeaways from it is that there's something going on, and I'd love to get everyone else's perspective, but it's worth highlighting. There's something going on that's driving, and maybe many things, but there's something going on that's driving valuations for small and micro caps materially lower than they should be, even in sectors where you're really valued based on your assets and the cash flow from those assets. So, you know, for oil and gas in particular, it shouldn't be as much. And there's this very wide performance and valuation divergence. So that's what's been going on beyond just oil prices and gas prices going up a lot and then down a lot recently.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's QUARTR. Now back to the show. I want to go on that question. I think that's a really good place to continue to go off of there, Josh. So, I mean, Jason, Yaron, do you have some thoughts on what the last part having to do with, you know, what is potentially driving it? Are there other factors that are driving this real material change and devaluation of some of these small microcaps?
I don't have the stats in front of me, but there's definitely been a secular shift from active to passive, and passive favors larger market caps. You know, when people decide to put their entire 401k into the S&P 500, you know, that's money that's going into Apple and Google and Microsoft. That's not going into small caps. And active, you know, managers have been losing share over time. And those are the guys who really like to, you know, hunt in smaller, less followed names. And then they're also less liquid. You know, they tend to be less profitable. They're not buying back stock. So, you know, if 10% of the people in the world who own Apple stock decide to sell it for some reason, Apple's there kind of giving them the cash and taking the shares from them. Smaller companies in general are, you know, not making cash and burning cash and need to access capital markets. They rightfully so have a higher cost of capital. There's less business diversification, less customer diversification, less supplier diversification. So their cost of capital is higher, number one. And number two, you know, when people decide to pull money out of the market, there's no one there, you know, with a bid. So just less liquid, and it's more likely to go down faster and you know, kind of more viciously.
Yeah, I would really emphasize the cost of capital concern, because I think particularly in a downturn, I mean, even outside the sort of any kind of commodity space in microcaps, you're always concerned, even in a good market, like, is my investment going to go into the market, sell a secondary, and then, you know, raise high cost equity capital? And particularly in this market, I mean, it's extremely expensive. But we see over time and time again, you know, weaker microcaps, weaker management teams really, you know, too often go, you know, just are happy to sell shares. And it sort of besmirches the whole microcap space, right? Where all of us have probably been stung by some investment we had that sold shares at the wrong time, and particularly in more capital intensive spaces. And I presume, oil and gas is more capital intensive than some other spaces, even in microcaps. That's a concern that I would have, and perhaps, and maybe the other thing is if you're looking for commodity exposure, you could say, well, I can get so much gain even in the mid cap or slightly higher space. Why take all this other risk down in microcap land? I mean, this is but I'm not a commodities guy at all. But one other thing I would like to add, and Yaron, you're probably worried about some of these concerns too, is like the strong dollar is an issue now for some of my investments, and I'm sure it's probably an issue for some of your investments. And anybody who has any kind of investment in microcaps that probably don't have a strong hedging program, they're probably exposed to for a lot of foreign currency risk that other larger companies may not be. So that's something to be concerned about, because the dollar is really ripping higher, and it's really an amazing thing to see.
Yeah, I would actually think the stronger dollar impacts larger caps more than smaller caps, because they tend to be more more global in nature, the bigger companies than small companies. But clearly, they're not as sophisticated at hedging it out. But it's not just hedging; it's everything. Management teams of small companies in general are going to be worse than management teams of Fortune 500 companies. They obviously can afford to pay less. They're not going to have as many Harvard MBAs, not that that's the end all be all of management team, but like they're going to have, more people who have kind of gotten there through maybe politics, and not that doesn't exist in large cap companies, but, have gotten there without really understanding, what their WACC is and how to deploy capital and what the right thing to do is for shareholders, and may not care as much about shareholders, right? I think if you in general, if you open the proxy of most companies in the S&P 500, I think nowadays you would find like a total shareholder return metric in there, boards that try to hold the larger, companies, management teams accountable to the share price. I think smaller caps, it's a crapshoot. You might get a board that doesn't care about the stock price. You might get a management team that doesn't care about the stock price. You might get a board or management team that have no idea what to do to get the stock to go up. So I think there's a higher cost of and there's just more business risk. Smaller businesses, by definition, just have more business risk, right?
I'd be curious, Josh, in your own, whether you're actually seeing opportunities in, since the dollar is kind of strong, particularly in sort of micro cap or smaller cap spaces. Are you seeing opportunities in other countries, whether it's Canada or Sweden or other regions that put maybe that have been very much beat up, but sometimes you get some very interesting companies, particularly in Sweden, I think these days, or the Nordics.
All in. I mean, I own a bunch of EMPs and service companies in Canada, and there's been a tremendous, if they're not hedged on their oil production, their oil and gas is actually selling for a large premium in local dollars versus what US producers are getting in local US dollars. So Canadian producers right now might be getting, if WTI is at like 97, they might be getting 125 or something Canadian dollars for their light oil, minus a differential, minus whatever, but companies here have to pay differentials too. So, and there was a moment where with the dollar versus Canadian dollar differential, which wasn't as extreme a month ago, but it was still pretty wide. There was a moment where Canadian producers were getting $150 a barrel for their oil in local Canadian dollars. So there's a detriment from oil demand sort of worldwide from the dollar being stronger, but there is a benefit for local producers to the extent that their input costs are at least partially denominated in local currency. And then once they are running, if you don't count the initial capex, like if you buy something that's not going to invest a lot, where there's not a lot of drilling or whatever to do, then it's just a question of like how much of the operating costs are denominated in local currency versus how much are sort of dependent on steel or some other sort of global commodities that are dollar denominated. So yeah, it's actually been, I think it's underappreciated, and it's kind of this weird thing where you try telling people, hey, these guys have this extra benefit, and they're like, hey, are you Canadian? It's like, no, I just like money. But,
Yeah, I haven't really made new investments based off of the FX moves. I mean, I'm cognizant of how they impact some of my businesses, but it hasn't really been a driver of any investment decisions for me, other than the understanding how it impacts the existing portfolio. If that makes sense.
Are you spending more time looking at existing names or small, like starter positions you had in your portfolio, maybe bringing those up, or are you hunting more on like totally new names?
Yeah, I've spent a lot of time underwriting and re-underwriting existing positions just constantly this year. It's definitely where I've spent a lot of time. I am looking at a lot of new ideas as well. But I think you can't get hurt by something you don't own, right? You can you could have foregone gains, but like things that and things that are down, you could, to your point, like in a market where everything is down together, you could, in theory, rotate out of something that's down for reasons that are rational into things that are down for reasons that are irrational. So I've definitely re-underwritten, the entire portfolio. I've shifted capital out of names that I think are down for rational reasons into names that I think are down for less rational reasons. I continue to always look for new ideas, but I think I found that during downturns, I just constantly am catching up with existing management teams, looking at credit docs and making sure I'm comfortable with the leverage and making sure I'm comfortable with what a downside earnings looks like and what I think a downside multiple looks like, and just staying on top of the businesses, which, there's new information every day out there about one of your companies usually. So
that's for sure. Hey, Jason, same question. Can we throw that same question back at you? Are you hunting for new stuff, or mostly, just checking in on?
I mean, I think it's a mix. And one of I think the dangers of maybe coming out of a market that was fairly valued, or perhaps some names are a little, let's say, above valued, is that you tend to sort of lower your quality standards right before like a bear market, right? And then you're looking at sort of names you probably wouldn't have considered 5 years ago, but you were looking at them a year ago. Those names drop down, and suddenly you're looking like, oh, the name I was considering has dropped down 40-50%. You know what? You shouldn't really even be thinking about that name in this market. And I think that's one thing you probably investors should consider. But my feeling is I like to have like just tiny little small positions in a number of names, like minor league players, and then bring them up to the major leagues, right? So I'm very cognizant of the risk of taking someone I don't know, an investment I've never just started to look at. It looks kind of sexy in a bear market, right? You put it into the portfolio at a decent percentage, and you really haven't really underwritten it very well. You don't really know it very well. It's probably a much lower risk to take a small name, bring it up, it better. I think that's the better way to go. So I'm kind of reluctant to take on completely new names in a bear market.
Got it. Interesting. Josh, same question.
Yeah. Well, so I want to talk about this, but I wanted to follow up on the feedback from Jason and Yaron on small cap discounts and microcap discounts, because those are great pushbacks. One of the things that happened in oil and gas was that almost any company that was inclined towards that, or that wasn't extremely well governed and extremely well capitalized, went bankrupt. And so we're in this scenario where there are a couple of companies that have behaved not so great, let's say over the last 18 months or so. There were a couple of companies where they gave themselves a lot of stock or did insider deals to get through COVID. And so those are hard for me to own. And then there's a few that have done highly dilutive deals for various reasons that don't make a lot of sense as an outsider. But in many cases, if not most, the companies have either partially or fully deleveraged. So financially, they're less risky. They've all cut their operating costs substantially. And so there's this sort of effect, and maybe it's that the small cap oil names are different than the broader small caps, maybe because there was this long down cycle. My bet is that some of the other commodity producers are more similar to the extent that they're producers and not exploration companies. But they don't really, I don't think it would be appropriate to characterize them with some of those same things. And in terms of management, I don't know. I mean, I'm not convinced that the management at the large cap or mid to large caps in general in oil and gas are any better than the management at the small to mid caps. Like, I know in many cases, both people at all levels at these various companies, and it's not obvious that they're better. And in some cases, some of the SMID caps are like owner operators who might actually be measurably better than the sort of career management people at the sort of larger caps that have been around for 100 years. So it is interesting. Maybe there is this reason for small caps to be cheap generally, and then smaller cap oil and gas, which I would argue shouldn't be as discounted. Maybe there's some discount appropriate, but if they're delevered and if they're appropriately managed, and if they're behaving in a manner that's strategic, where they're deleveraging and then returning capital and not spending irrationally or growing for the sake of growth, maybe they're getting sort of this small to large discount in line with the market, but not necessarily appropriately. And sure, the stocks can trade down a lot, right? So I think the market mechanism that you guys were talking about is very relevant. I mean, we saw it this morning where there were some small cap oil names down 11% and there were others down 3%. And it's like, okay, well, what's the difference? And I know them really well. And they're like names that were almost identical, except, different shareholder base. And so, to me, like you guys were saying, amazing opportunity, right? I sold some of one thing that was down a little and bought something that was down a lot, where I have a strong view on the assets and people. But it's just really, I just didn't want to leave that because I thought that was really interesting feedback, interesting perspective. And I do wonder to some extent if in other sectors, to the extent that this will be a prolonged downturn in various other sectors in small cap, if there will be this sort of bifurcation where the weaker names go under and the stronger names end up being really investable. And it's not something I've spent time on, but just hearing that feedback, that kind of sounds like oil and gas in 2015 or 2016, sort of 2 years into what ended up being a 6 or so year downturn. And then in terms of, cycling out of names or whatever, I mean, it's a little different because I am sector focused, but I don't really have a strong preference for companies I own stock in. I'm a little less likely if there have been a couple of companies that have gone public through either SPACs or IPOs or whatever in the last few months in upstream, and then a few also sort of on midstream and services. And, I'm a little less likely to invest in them, but it's possible to appropriately diligence them. For me, it's more about just tracking my assessment of current valuation from a liquidation value perspective, from a discounted cash flow perspective, and then comparing that to peers and just trying to own things that are well run, that I think are likely to grow their value at the maximum discount, and then also avoid taxes.
Josh, by the way, you don't have to say that you want to comment on my pushback. You can just say that guy doesn't know what the hell he's talking about. Stay in your lane, paint protection boy.
No, I thought it was great.
I'm just joking. Right.
The point of this is to learn and to engage, right?
Yeah,
it's not like Twitter where you just la 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 whatever. It's good. I appreciate it. And it's really, it's interesting, right? It's not something that I had really thought enough about. And it's great to get your guys' perspective.
For sure. I like Jason's new name for himself, Paint Protection Boy. I think that's pretty good. I hope that sticks.
That's pretty good.
I hope that sticks.
Yeah.
So, another topic I wanted to ask, because, that the fact that we're in small microcap land, that means we're all talking with management pretty often. I'm talking to a lot of management teams, and the main thing that I've been seeing across the board is basically M&A is more or less dried up. Deals are just not getting done. And the focus now, especially if they're revenue generating, is just really on revenues. That's really been just the core, head down. We just need to do this right now. So I'm curious if, what you guys have been hearing, talks with some of your management, some of those channel checks and stuff like that. Yaron, you want to start us off there?
Yeah, I actually want to pull something up if I could find it quickly. I asked one of my management teams actually last week about M&A. I said, hey, things are probably getting cheaper. Are you guys getting more excited about the M&A pipeline? And his exact answer was, a weak market should help the M&A price and pipeline in theory. However, sellers generally think they have a pot of gold to sell and are hesitant to lower pricing, and often will delay their sell decision until the economy recovers, thus lowering the pipeline. I think in periods of volatility, sellers think that they want to sell off LTM EBITDA, and buyers want to buy off NTM. So trailing, last 12 months versus next 12 months, and the views of what the next 12 months look like could be very different between the buyer and the seller as well. And then same with multiples, sellers might be anchored to last year's multiples and buyers are looking at current market multiples in terms of what they want to pay. I think when, there's a lot of volatility, bid-ask spreads just widen in general, and that leads to less trading activity for market makers and less M&A. I think I try to stick with companies that have good balance sheets and could really capitalize on a weak economy if there are distressed sellers, but with the understanding that, the typical deal activity might slow down until you have a sustained downturn, or until, there's a little bit of light at the end of the tunnel, at which point, the buyer might be willing to stretch a little bit more because they feel like the end is near. Look, if M&A slows down and your companies are generating cash and they're growing, they could buy back stock. They can build up cash on the balance sheet to wait out until sellers are willing to come around to it, or until the economy recovers and then the sellers come back. So that's kind of how I'm viewing the portfolio in terms of M&A right now.
Absolutely. I'm going to jump to Josh. Josh, what do you think on this?
I think, so again, oil and gas, it seems to be operating in a slightly different cycle right now. One of my company's very small position was bought out for a premium this morning. So that was exciting. And if it looks like I'm looking down, I've actually been in the process of cycling out of that name. It was a stock for stock deal at a 25% premium, and the buyer's stock is down 15%. And the seller's stock is up like 7%. So it's a little bit of a arb, which I'm not going to stick around for probably. And so I've been in the process of like literally selling a name that's been up anywhere between 2 and 10% or 2 and 8% today, and buying a name that's been down anywhere from 4 to 10% today. So it is happening. Premium deals are just starting to come back. But what I saw was it was really hard for companies to do deals in a downturn, and it was a lot easier once things had sort of bottomed and then started to recover. And so my guess is that we'll see that sort of, to the extent that there is this sort of broader downturn economically and in the stock market, I think there will be that sort of bid ask like the others were saying. And I think that we'll see as things start to recover, it gets easier for a seller to accept something, even if the buyer stock has, inflated to some extent. It just gets easier once they get their number. And we've seen that a lot, I think, with private equity backed companies in oil and gas selling to public companies, where it kind of doesn't matter how much the public company's stock has gone up. It seems the seller just wants to get their sort of nameplate, their sort of ask number hit. In some cases, entirely with equity, in some cases, equity plus cash or whatever, or assumed debt. But it does seem like that really helps clear the market. So maybe we'll see less M&A, like you guys are talking about, on the way down, and then more as things bottom out and then start to recover. So that's what we saw for oil and gas. And it is helpful, I guess, for me to see that deals are still happening, because to some extent, that's a signal, at least from a management and board perspective, that oil and gas execs aren't really expecting this to be a big downturn in the industry.
Got it. Jason, what about you?
I mean, I think you made an interesting statement, Robert, at the end of your end of the question. You said you're talking to management teams to focus on generating revenue. Always a good thing. And you also have some other microcap management teams which are focused on generating profits. Always a good thing. But there's a lot of management teams in microcaps who don't generating much revenue or aren't generating much profits, right? And unfortunately, I'm sure none of us have those companies in our portfolio, but some other microcap investors do. And what I'm concerned about are people seeing, and some of those names have really been destroyed, right? And I think there's a risk of people just loading themselves up with a lot of destroyed companies. Perhaps they're trying to, find a way to make up what they lost. And I think it's very dangerous. So I would be concerned with investing in microcap companies that don't have a very clear pathway they got to have a clear pathway to profitability, or they got to really be profitable at this point in time, particularly going into what could be a downturn. Because otherwise, you're just going to find yourself getting diluted or find yourself with a very generous, carry forward tax loss going into next year.
So if I'm reading the tea leaves right now, some of those growth tech names, that are maybe still in prototype phase, or maybe just rolling out pilot programs and stuff like that. You might want to. I mean, how about let's try and help those. Let's turn this around. For those that may have exposure to some of those companies and believe in the tech, maybe believe in management, they've done it before, this is their next big thing. What are some things that they can do at least to protect themselves, other than just straight up like, hey, you got to lose or sell it? What are some of the channel checks that they can do to make sure that they're, at least checking with those companies in a way in which they're saying, oh, okay, they're doing what maybe that you would expect or hope they would do in times like these? Jason?
I think it's very tough because, a lot of management teams are natural optimists, or they have an incentive to be optimistic or present optimism, right? You never call up a management team and ask, how are things going? It's right. It's always, if it's bad, it's challenging. They never say we're going to close the door next week, right? Do you want to buy some cheap furniture? I think what you got to see, if you can, not all companies you can really do like very good channel checks, right? Some are just more difficult to check. But if you can see whether, what they say is basically the timeline they give you is more or less accurate, right? There are companies out there that they can survive 18 months, but they can't survive 24 months without, conditions really improving or their product starting to really take off. And that's a very dangerous situation to be in right now. And like we said earlier, so many companies, like Yaron put so wonderfully, right? A lot of companies are down rationally, and you can move to investments which are down significantly for irrational reasons. So, don't be afraid to take a loss. It's not personal. It's just business, right? And that's the famous line, right? So
I just rewatched all three, just rewatched the two of them the other day. So. By the way, everybody should.
I do know. I think there's some investments that are jockey bets for people.
Right.
I think in general, if you're making a jockey bet, you still better like the underlying business and asset. I think Warren Buffett has said that you should buy companies that any idiot can run, because eventually, if there will be an idiot running it at some point. And I think it's accurate. I think if you're buying a speculative company that has no revenue, no profits, purely on the prospect of future revenue and profits, it is a much, much riskier investment, and it should be sized appropriately. And, your return expectations should be extremely high if it works, because if it doesn't work, you're going to lose a lot of money. And if you only double your money on those types of positions and you do a handful of them, realistically, you're going to lose a very big chunk of the handful that don't work, and you're probably not going to recover your losses with the handful that do. And so I just think it should be sized small. You shouldn't be doing it for low returns. You should be doing it for high returns. And the underlying business is the most important thing. That's what you're buying. That's what you have an ownership stake and interest in, not in management, right? You're buying a piece of paper that represents an ownership interest in the underlying business. And to Jason's point, management teams have every incentive to paint the rosiest picture possible, even when things aren't going according to plan, right? And it might not even be malicious, although sometimes it is nefarious, but it could just be that they have a mortgage that they need to pay. And if they, lose the confidence of their investors, they're out of a job and they can't pay their mortgage. And, they're getting paid to, make sure that there's a bid for the stock and that they could raise capital when they need to fund this loss-making operation. And I think the board and other shareholders expect them to do their job, which is to paint the rosiest picture out there. So, sometimes they're crossing the line and committing fraud and lying and saying things that they know are knowingly false. But sometimes they're just being optimistic because that's what they're incentivized to do. And maybe they somewhat believe it, or maybe they just think it's going to take a little bit longer, but no harm, no foul. But I do think your return expectations should be much higher for those. And at the end of the day, all you own is a stake in the business, not in the management team.
Very good. Josh?
Yeah, so I guess the equivalent of that would be, at least sort of in the area I'm most focused on, would be sort of exploration companies where they're not really generating much revenue or cash flow. And it is wild in both directions, where there are sometimes really promising opportunities if people have done it a lot before and getting in early enough. And like Yaron was saying, you really, I think you got to size it well. You have to really diligence it. You have to have a real shot at a 10X or something like that. And then, it is remarkable how many still companies with no revenue will get crazy. I mean, it's not even a valuation because they have no revenue or cash flow, but it's like, hey, we have this big land position and here's this 10-year-old report, and ignore the like smart industry people who sold the asset for nothing recently. We've got this. And, and in many cases, it's the team itself like has done this before and it's been a zero. And it's like, ignore that. Oh, here's these new guys who are good. And like, I'm actually describing, I think, 3 things that are going on right now. Like 3 different situations. And like, to the point where I've occasionally commented on them by name, which I won't here. And there is like thousands or hundreds of people very mad at me for having done that. And that's also an indicator, right? Like you should be able to say basically anything reasonable and fact-based about any company and not elicit insane emotional responses. So I think that's like a good criteria too. If you find yourself feeling very strongly based on narrative, based on people, based on things other than sort of data that, is from a reasonable source that, has aligned incentives with you. I think it's good to sort of be careful. And then I think especially sort of from an oil and gas perspective, we went through this long downturn, and there were many times where you could, if you owned things, and I made this mistake occasionally, I would own something with less cash flow and I could buy something with more cash flow, and the upside prospects were similar. Like there wasn't really a good argument for owning the thing that was riskier with the same upside as the thing that was less risky. So, it's like a couple of these exploration things too. It's like, okay, you can own them, zero, infinite valuation because zero cash flow, or and your upside is X number of barrels in the ground, or you can own something at like 2 times cash flow with a bunch of barrels in the ground, and maybe it's fewer barrels, but your odds of actually getting those barrels are way higher because there's cash flow. And you might or might not be as excited about the teams, but at least there's a business there and there's cash flow there, and you have an idea on what the returns are, and there's way less technology risk and so on. So I imagine that's probably generalizable to some extent. It doesn't mean that you don't get exposure to things with huge potential upside. It's just, if everything falls, maybe you own the things that generate more cash flow and have less risk. And if you are going to own them, I think, to Yaron's point, I think you got to be real careful, have to have a real high potential return, and size it in a way that you don't blow up if you own something like that.
Yeah, I will. I'm sorry, go ahead.
Go on, you bro.
I was just going to say, like, I think given the environment we're in, right, and financial conditions are getting tighter, and the Fed might keep tightening them until inflation rolls. I think it's very important to just understand whether your company controls its own destiny and have higher return expectations for companies that do not control their own destiny, right? If you are, I would say the riskiest proposition is a company that needs access to capital markets to raise primary capital, new debt or new equity to fund the business. That is riskiest. If you need that, and capital markets are shut when you need it, you're effectively going to have to hand the keys over to someone else who's willing to put up the very expensive cash at that point. Then a little bit less risky, but still risky, is someone who needs access to capital markets to just roll an existing capital structure, right? Near-term maturities or covenant breaches if EBITDA goes down too much or cash flow goes down too much. And then obviously it's companies, that generate cash and have strong balance sheets that are probably the safest from, a funding standpoint. So those are the ones that really control their own destiny. And I think it's really important to differentiate between them, especially in an environment where you're not sure what the economy is going to do over the next, 6 to 12 months.
Jason, you were going to say?
Yeah, I was just to add one point. I think Josh brought up a very sort of interesting phenomenon that we all see, which is that you can criticize a name, and especially if you do it on Twitter or other places, other boards. Sometimes you'll have these fanboys come and like hit you, right? And better investors don't take it personally if someone criticizes something they own, right? In some ways, if it's an intelligent criticism, you should be drawn to it, right? You should want to explore it more. And I was just going to say that I think in a bear market, probably the biggest risk are your own personal weaknesses. It's not inflation, it's not interest rates. It's just your own personal behavioral biases that sometimes have not been tested in the bull market, but are likely to be tested in a bear market. Whether it's a desire to over concentrate or perhaps be too diversified, or it's a desire to always have positive returns every year, and therefore you take whatever risks to generate positive returns, or it's just a desire always to compare yourself to other people's returns, even though they have different skill sets, right? I mean, really, which I probably should all be studying is just our own selves, just trying to figure out, like, what are my weaknesses that I really need to take care of and to fix or to watch out for, if in a longer bear market, like the 20 COVID bear market, that was so quick. Right. I mean, you really, before you blinked, it was away. But I mean, I know a lot of people, just thinking back to that, 2000 to 2002, right? They just, people sometimes can't take pain for an extended period of time. And that's when you really get into danger, right? And okay, even if you underperform a little bit in the bear market, number one priority is to survive, to get to the next bull market, right? And if you blow up, in a spectacular fashion, or really underperform in spectacular fashion, it's really hard to come back from that.
100%. Oh, somebody want to add something to that, or? No?
It's very well said. I agree. Surviving is, I think, the most important thing, and that that includes not having too much leverage yourself and not owning businesses that have too much leverage, on their part.
For sure.
I mean, look at the crypto boys, right? Look, I mean, it's a different space, right? But look at the crypto boys, right? And how much?
Watch out, Jason! You're gonna unleash the fury.
And that's it for today's podcast.
I'll just leave it there. Just look at them. Just draw your own conclusions. We'll just say that. Look at them and draw your own conclusions.
So one thing I'll share. So again, like, this oil cycle seems to be playing out slightly differently, and it's scary because maybe everything falls another 50% in line with the rest of the market here or not. I mean, I like the supply demand setup, but there's a reality, which is the market can do things that maybe aren't so fundamentally supported for long periods of time. One thing that I did that I think was really helpful and was really hard, and I think is worth sort of thinking about for this cycle in the broader market, is I somehow managed, and I can't really explain it well, I somehow managed after COVID, right, where like oil went negative, to position where when there was this vaccine and where the oil stock started to recover, to be able to own things that could do really well. And that was really hard to do. And I can't fully explain it. Like, I don't have a good, I just, think it's relevant for this. If you can somehow get through the bear market without being so scarred that you're not able to capitalize on it. Many oil and gas investors just missed the whole thing. Many were setting up alternative energy vehicles at like the historically worst time in history to do it. A lot of the private equity funds did that and like took billions of dollars in and blew them up from like November of 2020 to, June of 2021. I mean, it was just absolutely insane seeing it. So almost everyone missed it.
Don't you criticize my alts, man. Don't you criticize my alts. That's how I can say.
Well, I mean, right, exactly. So, and that was like super, like no one wanted to talk to you from an allocated perspective. If you weren't doing that, it's like, what's your plan? What's your whatever? And, many firms, I think, embarrass themselves by jumping in. It's not that I have a problem with doing it. It's that I have a problem with doing it at the bottom of your sector and at the top of the other sector that's adjacent that you jump into. And like, there's lots of deleted stuff and lots of, oh, hey, we're like rebranding back to oil and gas or whatever. But I think there is this importance, both I think financially, like Jason and Yaron were talking about, as well as psychologically, to be there for when the turn happens. And again, it's impossible to time that perfectly, but to be able to have meaningful exposure to whatever it is that you're doing such that you benefit when it goes up. And if you're not there, then you can't benefit when it goes up. And so it's like kind of that Peter Lynch, like, don't try to time a recession, because you might lose way more money trying to time it than you would actually lose if you experienced it. And then the pair to that is just to make sure to have the exposure. And I guess it's kind of this like cliche from brokers, right? Like, oh, like the 10 best days in the market represent 80% of the market return. But I mean, it's a cliche, but it's also true. And so however it is that it's possible to position to be able to have that exposure, I think matters a lot, because it's the difference in between sort of it having been painful and just kind of sucking versus it being painful and then it being worth the pain. So anyway, again, I can't explain how I did it. Just somehow managed to not have been so damaged through negative oil and through insane drawdowns. I mean, PSCE, the small cap index, I think it was down 95% or something from its high in 2014 to its low during COVID. Something like that, right? Just absolutely.
Josh, how do you sleep at night knowing that you set yourself up to profit from the demise of the earth? I'm just kidding.
Well, I mean, we have Sri Lanka starving right now, and so it's.
I'm kidding. You know.
Right. No, I get it. Right. It's like it's a tough thing from a lot of perspectives. But the biggest thing I think is not I think you can kind of convince yourself of various things morally in terms of.
I was kidding.
No, I got it. But yeah, I think it's really hard to do that. And I think that's where, a lot of the return is just from surviving and being able to have the exposure for a bull market. Bull market starts somewhere. And, if you are in cash and you like try to time it and whatever, and you miss it, it can be hard. A lot of people missed the last sort of 10-year plus equity bull market because they were scared from the things that happened in the financial crisis. And, I think there's a lot of risk in trying to be that person versus trying to understanding that the market does go up over time and that there's a lot of rewards in capitalism from optimism and just trying to find things that will allow you to survive, but then also give you market or better exposure over a full cycle.
I think one other thing we have to sort of watch out for is that, there's a tendency to be like the accidental macro investor, right? We see all these, front page news on inflation or interest rates.
Literally took the next topic out of my mouth. I love it. All right, go. Sorry, I didn't mean to.
All these people who, you see all these headlines, you go on Twitter, there's all these comments, everyone's bringing up, the 1973 bear market, or or Volcker, or like 90% interest rates, right? And people who are very sophisticated, sort of, equity investors are like can sometimes fall for the most unsophisticated macro interpretation, and then change their whole like equity investment approach just to fit this naive macro, viewpoint. And so it's just something to sort of, watch out for. And honestly, I mean, and we know this, we all know this. It's not easy to predict like macro. It's not easy to predict what's going on. I mean, just a couple of years ago, like how COVID, like all the experts, I mean, who predicted it and how it was going to play out, right? And now we're listening to these same experts, predict what's going to happen about inflation or interest rates, and we're all like nodding our heads and then giving a like to someone who generates some like JP Morgan chart. So
and by the way, the macro forecasters sound more confident and more convicted and more convincing after they're right, which is probably the exact wrong time to be listening to them, because nothing is ever as good or as bad as it seems. But after a strong run, and a lot of investors are prone to feeling overconfident after a strong run. I think, when the market's down 20%, it's a less attractive short definitionally than before it was down 20%, but bears might sound more convicted. And when the market's up 20%, it's over a short period of time, it's less attractive as a long, but bulls sound more convicted and more confident. And if you were on the sidelines, you might get more drawn to the argument after that move, when it's probably a worse risk reward at that point. So I think it's very, to Jason's former point, just know your behavioral biases, have a strategy, stick to it. Don't let your emotions override that strategy at the exact wrong time, because that's the surest way to have bad, through cycle performance.
But one quick question on this, to be fair, because, so much information is being thrown at us, so much market news and stats and this and that is being thrown at us. And it's sometimes very difficult to separate between the noise and what you should actually be listening to. But I want to ask the question like this, how much, even with all that, and still
they should be listening to your podcast, Robert. They should be listening to you.
Without question, duh. If they listen to just our podcast or my podcast, it would, they should only be investing in microcap stocks. That is not investment advice. But but in all seriousness, because there is some level of all right, you probably should be listening to some of the noise. You should be understanding some of the things that are going on out there, but clearly for probably the majority of it, I don't know how much more thought pieces I need to see about this Elon and Twitter deal. But in all seriousness, how much should you really be paying attention versus all right, you can push this to the side, Josh?
The average person should not be paying. Honestly, the average person should have a strategy that's easy to stick to, which is over time, I'm going to own equities while my duration is long. And as I get closer to retirement, I become less overweight equities. And this is a generality, not investment advice. Obviously, if the S&P was selling for 50 times earnings, that it would probably be a little different. But if you're able to buy the S&P at 15 times or 20 times earnings, and you have a time horizon of decades and you're young and you're looking for retirement, you really should just stash it and average in over time. And if you want to follow the minutia and be in the weeds, I think it's important to have a strategy. If you're going to panic, you better panic early, right? You can't panic after the market's down 20%. Then if you get out, then you are locking in losses. And if you don't get back in time, those losses could become permanent losses. So if you're going to have a strategy of owning equities for long periods of time, then you should not touch that regardless of the minutia. And if you're going to follow the minutia and you want to panic every time things start to sound bad when we're at all-time highs, you'll probably have lower returns, but at least probably, I would think, positive returns if you get out of the way every time we're at all-time highs. But if you're going to panic when we're down 20% every time, I think realistically, you're probably going to have negative through cycle returns. And then the other thing I'll say is that, yes, if you got the inflation call right and you got out of the way in equities, you're doing better this year. But I will take my chances with my portfolio over the next 10 years. If the current inflation sustains, I would take my chances over a 10-year period of my portfolio versus just staying in cash and thinking the S&P or whatever is going to go to 10 times earnings and the earnings are going to get crushed. I mean, if you buy a company for 10 times unlevered earnings and it's flat in 5 years, you've generated 50% of your enterprise value in cash, right? And after 10 years, you've taken your money out and you still own the business. If the business has a reason to exist and pricing power and a good management team, over time, you will protect your purchasing power, maybe not in any one given year. But if you are sitting on cash, it sounds dumb to say now because cash was the better place to be this year. But if you are sitting on cash over a decade with high inflation, you're guaranteed to lose purchasing power. So those are kind of my, two pieces of thoughts.
So I have three thoughts. One, I completely agree, Yaron, and I think just gets back to that sort of cliche broker thing, which is just if you try to time the market, you're going to miss the things that give you that you miss a lot of the magic of the stock market, which is compounded returns over time that are better than most other asset classes on a risk adjusted basis. And so if you that your attempt to do it and others' attempts to do it are part of why that excess return exists for that asset class. So that'd be one comment. Another is, I think, like you were saying also, there is this tendency to kind of find people that sound good and have been right recently. And it's way easier, kind of oddly, to do that than it is to, reread Margin of Safety by Seth Klarman, to like reread all of Buffett's letters and like notice what he's doing, or, whatever. There's this amazing resource of brilliant billionaires who don't make themselves that available, but you can find their stuff. And like, I'd way rather bet on like what Buffett's doing or what Icon's doing or what Klarman's doing than bet on what JP Morgan or Goldman Sachs or XYZ like guru person of macro person of the moment, like to the extent that I'm making a multi-year sort of bet and that I'm trying to be able to be there for my returns to compound. So I think like there are these great resources. They're often more boring, right? But like boring maybe translates to excess return. And so, just it's easy to access the things that are exciting or sexy or that sound good because that person called this thing that was improbable. And it's hard, I think, to attribute appropriate returns. And also like a lot of these strategists and stuff, it's really hard to find, records of their other calls. And I mean, I see this with oil and gas where there's lots of supposed experts who are just terrible. And like most of their calls are wrong, but like they delete them or they like make them really hard to find and they don't run funds. So there's not like a return to identify or so on. And so I think that stuff matters a lot. And then I guess just the last thing is if you can find businesses in whatever industry that can compound over time and that are well run and that are available at a reasonable price, to the extent that one is not just purely allocating passively to outperforming investment fund managers or just purely to passive indexes, it makes sense if you can find something that seems likely to compound over time and has reasons beyond that you can diligence and identify. I think holding those things over time and being able to add to them from cash flow or whatever, I mean, that does seem to be the strategy that Buffett and others employ. And if you look at it, I mean, I did some stuff on Buffett's like recent purchases of oil and gas equities, which were actually quite unusual for him over the last like 65 years, and tried to elucidate sort of what it meant that he was investing so much in Oxy and Chevron recently. But it doesn't have to be any particular sector. You can find these great insights from brilliant people who are so fantastically successful that they are billionaires, often from their compounding of their own investments. And so, I think there's just a huge advantage to that over the listening to most other people. So, here we are, not billionaires, talking about this stuff. I don't 100% know about you guys, but I'm definitely not. And I think there is a lot of available wisdom that we often overlook.
Bobby, I would be remiss if I went to one of your podcasts without mentioning Expel, right? It's just, I have to mention it, right? You
just can't, right? You can't help
I just can't go through a podcast without mentioning it. Okay. So look, what a moron. And I bought it in 2000.
Wait, you call yourself Ink Protection Boy?
Yeah. What a moron I must have been, because I bought it in 2016 after the first hike of a 9-hike Fed move, right? There's a hike in December 2015, another hike in December 2016, and then another 7 hikes after that, right? So, I mean, anybody who's like so focused on interest rates should go back in their portfolio if they own stocks for a number of years and like just ask themselves, like, I mean, how much did you at what point in time, what part of the interest rate cycle did I make other successful investments, right? And a lot of times it doesn't, I don't remember like when the interest, what part of the interest rate cycle I made this or that, right? I bought like MasterCard in like 2006. There's like 1 week before, I think it was June 21st, 1 week before the hike on June 29th, right? In 2006. Like, oh my God, it went up to 5.25%, extremely high. It didn't make a difference, right? If you buy the great companies, if you can find, a good solid investment, usually the interest rate cycles don't matter too much. There are always, exceptions to the rule, but I just think we're spending so much energy these days as an investing community, just looking at just these.
I mean, the shorter your time horizon, the more you need to catch the right factor and the right sector.
Yeah, sure,
time.
Right. If you're a trader,
I do think in general, active management has been bullied into shorter and shorter time horizons for a variety of reasons. And I think that it's really hard. There's way less people in the world who are good at jumping from sector to sector profitably and strategy to strategy profitably than there are people who could follow a tried and true strategy of buying good businesses at reasonable valuations and holding on to them for a very long period of time, which is a very simple strategy that it's proved to have worked for a very long period of time. And most billionaires have done it through owning a single business for a very long period of time, or a collection of businesses for a very long period of time, and not trading in and out of them. I think Howard Marks, has said that something like if you stand at a bus stop, you're gonna catch a bus, but if you run around from bus stop to bus stop, you might never catch a bus, right? Because you're trying to catch the bus and then you just miss it, and then you run to the next bus stop. You might have to wait a little bit, but you will catch a bus if you stay at a bus stop. And I think if you have a strategy that has a long duration and you're happy making equity-like returns, you have to stick to the strategy. And if you're trying to jump from bus stop to bus stop, you better have a really good watch and really good sneakers and be able to run really fast, because if you miss it, you might never catch the bus. So
it is funny that you mention that. Because Oaktree bought a giant amount of oil and gas securities during the downturn, and their business is literally jumping from one bus stop to the next in order to catch that sort of, and they have a distress strategy. But I guess the one, I completely agree with what you're saying, except that there is a caveat, which is if your strategy is, hey, find something where there's a 10-year cycle or 20-year cycle, and it could be similar to quality businesses, right? Where maybe you want to own for a while, mostly businesses in a certain sector that or you find that they tend to be really undervalued in, adult entertainment, or they're really undervalued in, grocery or whatever for some period of time, and there's compounding. But I think it is just funny to point out, Oaktree is the opposite of that, to the extreme, where they'll end up with huge exposure in one or two sectors for a few years, because that's where sort of the valuations were.
I do think that a company like Oaktree, though, they have these opportunity funds, these supplemental funds, right, which they can tap during moments of distress. They don't have to even hold on or get those funds from their LPs, right? Like Op 7B, I think they were able to tap during the Great Recession, which allows them in some ways to do timing more effectively than mere mortals like us, right? Which in essence have long-term capital that we have to do something this year, next year, the year after that, and 2 or 3 years before, right? So one of the weird things about being an investor, right? We're always we have a tendency to try to ape Buffett and Munger, who are fantastic quotes, but they have very long and varied careers, right? So you could try and copy a young Buffett or a young Munger who took a lot of risk, and took leverage, or you could try and copy the old wise Munger who tells you to stay away from all sorts of debt, right? I guess we don't want to get there because these guys are gods. But
did you see Daily Journal apparently levered up recently to buy some stuff? So apparently, they literally put on. But Munger spent decades telling people not to put on portfolio leverage, and they exactly. Went on, I saw some article. They went on margin to go buy some stocks recently. So anyway, it's kind of funny that you mentioned that, because I think it's and that's one other thing that you always have to be concerned about, even though I'm sure we're all people on this podcast who do exactly what we say. But honestly, I know a number of investors who what they do and what they say is somewhat different, right? And whether it's purposeful or just by accident, it's very easy to give you all the great Buffett and Munger and Templeton quotes, right? We all we're kind of like financial Monty Python fans, right? We could just spit out these quotes when needed, but it's the actual investing itself. It's simple to explain, hard to do. The danger is always when we fall for complex strategies which are impossible to do.
right? That's the real danger. And occasionally we all fall for that.
Absolutely. All right. I think we covered quite a bit today. And I know you guys are all busy, so I appreciate you everyone here taking the time. So, to wrap up, love to hear everyone's final take. I guess the final take being, how you're positioning yourself for. I mean, I know some of us here are more long-term focused, but just even if it's a short answer, but second half of 2022, either your thoughts on things that you're seeing or how you're positioning yourself. What are you doing there? So, Josh, let's start with you. And then of course, people can go and follow you and your website and all that good stuff.
Cool. Yeah. So the U.S. is releasing a lot of oil right now from the Strategic Petroleum Reserve, and that is scheduled to end in October. And so, again, long-term view that there's been underinvestment in oil and gas, and that should lead to higher prices and also much higher valuations, especially for the smaller and microcap producers. And there's a ticking clock. There's only so much time where oil can get released. There's a limited quantity of that. And so, I think that, and also the European energy crisis, are both things that I'm tracking, where there could be a lot less oil available for consumption, and there may be a lot more demand for it to replace Russian gas and other sorts of sources of energy. So, again, sort of longer term focus, but also it should be a really interesting, excluding all the other sort of economic cycle and interest rate and all the other aspects. It should be really interesting. Easy to find on Twitter or at bisoninterests.com.
Very good. Jason?
First of all, if you're annoyed at any of the comments we made about Munger or Buffett or crypto, please email Yaron Naymark. Don't contact me. Just email Yaron. He's the point of contact for any criticism. But you can find me at Hudson 215 Capital or at ATRAC 180 on Twitter. And I'm going to be doing what I always do, right? Which is just look for a few great companies at a really low price, and you buy them, and then you hope they go up. That's what I do. Not
when you say low price, you mean like $5 or less a share, or $10 or less a share?
Well, usually 15 cents or less in Canadian, right? No, but low. I mean, look, if you really want the great gains, I think you do have to sort of find companies which are moderate economic returns today, but really superior economic returns tomorrow, superior economic models tomorrow, which is not easy to do, right? So I just wait and hope to find a couple of them a year or every other years. And, it doesn't matter whether it's a bear market or bull market. It's easier to do in a bear market. So there we go.
There you go. Yaron?
I'm similar to Jason and Josh. I mean, I continuing to do what I always do, which is reevaluate my positions, compare them to other opportunities that I see in the marketplace, and trying to high grade the portfolio and re-underwrite and really know what I own. I've taken exposure down in sectors that I think are more interest rate sensitive in terms of demand, and that are more exposed to inflationary pressures in terms of their costs. And I've tried reallocating that capital towards businesses that I think are getting unfairly punished by kind of all these headlines. And of course, I'm protecting the portfolio by being short paint protection film companies and energy companies. But yeah, that's
where's the end button? How do I leave this, Robert?
Oh, that's good stuff. And Yaron, where can people follow you on social media?
One Main Capital is my Twitter handle. The website is onemaincapital.com. And my contact info is on the website or on Twitter as well.
Very good. All right, gents. Thank you so much for joining me today. That was a lot of fun. Let's all just, let's just go away for a couple more weeks, and then we'll recharge our engines and then just see what craziness happens starting in September. So I think with that, I really appreciate you guys joining. It's a lot of fun, and I'm sure we'll chat again soon. For full disclosure, Jason Hirschman is a shareholder in Expel Inc. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.